Well, congratulations on getting through the practice round successfully. What I'm going to try to do is walk you through the three sets of printouts that you have access to fairly quickly. But please don't take my quickness in going through them as indications of how quickly you should go through them. When I play this game, and frankly, when I'm watching what you all are doing, this is exactly the process that I go through to try to figure out what's happening. So the first thing I call up is the Footwear Industry Report, and I look right on the front page, and here's the story. So I told you my West Texas School of Management, how we doing, why we doing, and how we going to do better. So this tells me how we did. Now, just for the interest of time, I'm going to call myself Team F. I'm going to look at these as the perspective of Team F. I picked them because they're kind of middle of the pack. You can see in reality what happened was C walked away from everybody. Now, again, we all know this is a practice round and nobody cares, and it doesn't matter who wins and who loses. But for the standpoint of taking the looking at the product seriously, I have to act like it does matter, and that we're pretty much all in on what happened. So as I look around, I see C was in a league of its own, so I'm going to want to pay particular attention to C. And then everybody else was actually very tightly clumped, so I have to keep all 7 teams in my cross check. The order of finish was C, D, E, F, which is very handy in terms of keeping it straight because it's alphabetical. A below me, G, and then B. But again, there's not so much difference between D and B that uh, I can't really rule anybody out. Sadly, you'll find probably towards as you get into the simulation, 3 or 4 rounds, the teams that are down here, if in fact the norm occurs and they're separated out fairly significantly, you kind of ignore them. They're not relevant. Um, in the first For the first year, the game-to-date scoreboard is going to match the scoreboard for that round. This is where over time things will compile. And so if I go to my West Texas School of Management and the first step is how did I do, really at this point I know how I did. I see where I finished. Go on to the next page. You can see the same results in, first of all, earnings per share, C, D, E, F, return on equity, C, D, E, F, and stock price, C, D, E, F. So everything lines up. I kind of know how things finished. Sometimes you'll see small variations because somebody may be mishandling how they're dealing with their corporate structure, and you'll see some fluky things in here. Next page, credit rating. Everybody is okay. Image rating, this I paused to pay a little bit of attention to. Remember, this is a function of market share, quality of your shoes, and your corporate social responsibility. And I see as a group, we all kind of stunk. Only 2 met investor expectations. Come down to CSR, boy, somebody spent a lot, almost 9 million with an average of 2.3 million, a low of 0. These folks personally carried up that average. Probably the real corporate average would be around um, probably a million if you just took the real high spender out. And you can see for that they got 3 points in their image rating. Next page, forecasting accuracy. This starts to tell me why I did as I did. When my forecasting accuracy was bad, typically bad things happen. Actually, people were very close on their revenue, and that's a good thing. Where we see that the variances was in earnings per share. Some of this has to do with whether you assumed you were going to accept your special order bids were going to be accepted. And then no bullseye awards. Leapfrog award, this is something you only want to win once, if ever, because if you keep winning it, that means you're going up and down and up and down. The ups are good, it's the downs that stink. On to the next page. Not a lot that I really get here. I do note the trends in superior material pricings. I do note the reject rate because it's going to be important for me. Here it talks about the supply and demand analysis. There's still a little bit of oversupply in the industry, and I come down here and see that nobody initiated any new construction this year, so this is a good situational awareness tool. Next page, financial summaries. This is really important. So I start to look at, okay, again, I'm answering that why I did question. So my revenues, I can see that C was the top performer and was way out the top in revenues. That kind of makes sense. Notice in the next players, D, E, and F, though, I was the, well, wait a second, I said I was going to be, I forget who I said I was going to be. I think I really meant to be E. If I'm E, I can see that my revenues were a little bit lower than D and F, even though I'm very tightly clustered in performance. Warehousing expenses, should just basically track with volume. Marketing expenses, really not a lot of variation here. There may well become a lot of variation later on. Administrative expenses, operating profits, excuse me, you can see, boy, C just walked away from the rest of us. Interest expense, normal. Income taxes, function of how much money you made. Net profit, so this is where you can start to see what happened. And you see again, C was double what everybody else is. And that's a big deal. C did raise their dividend. Okay. They also issued quite a bit of stock, as did D. That's going to have some real impact. If I notice down here, C made a lot of money, but they ended up with a lot of cash on hand. So they raised, you'll see over here, they raised $60 million by selling that stock, and then they promptly did nothing with it. So we would put that into the category of probably a mistake. Here I'm just looking for anybody that breaks out. I was a dummy and ran out of cash, so I need to pay attention to that in my corporate finance. Everything is pretty normal here. Normal, long-term debt, nothing. Equity, normal. And now we start to see some differences in retained earnings. So you see here where they retained a lot of earnings and they sold stock. So notice how much their equity is. In future rounds, this is going to hurt them because their return on equity is going to have a bigger number in the denominator. Everybody held their dividends the same, except C went up a little bit. Now I come down into these statistics, and the thing I want you to get at by looking at these statistics is you have to be careful with them. They're good information when properly interpreted. For example, is it always good to have the lowest cost of pair sold? Well, C was lower, but I was second lowest in the cost of pair sold as a percentage of my revenue. Is that a good thing? It depends on my position and where my shoe is positioned. Warehousing expenses, marketing expenses. Again, you can see everybody was fairly consistent. I was one of the higher percentages in marketing. And the reason for that was I spent about as much in marketing as everybody else, but my revenues were lower than a lot of folks. So again, you have to be aware of what's in the numerator, what's in the denominator, what's my strategy. Operating profit, again, you can see that C just killed it, and that actually I was second highest in the industry. Of course, my revenues were lower. And then this is a real key piece of information, days of inventory. If somebody messed up and produced way too many shoes, this is where you would see it. This is excellent. Every company did very well. And even the 36 for C doesn't necessarily mean anything. It may mean simply that they've promised shorter delivery times to the retailers, the 1 week delivery time. And to meet that, they simply have to hold more inventory to make sure they never run short. The two credit risks I see here are more a function of them not making money than having excess debt. This next page is very critical in figuring out the why you performed. My products, they know I'm the administrator, but in your products over here, there's an additional column and it has your number for each of these areas. The real thing I want to tell you is spend a lot of time looking at this. Again, understanding where you're positioning your shoe. So being high or low isn't necessarily good or bad. For some of these things, you have to know where your shoe's positioned. Now, labor cost, you always want that to be low. And you can see here, even in the first round, there's a 70-cent difference. And given that you make about 6 million shoes, you're talking $4 to $5 million of profit right there based on how well you manage your workforce, because you can see the differential in Asia Pacific is actually a little over 80 cents. So the rest of these, just look at how you compare for the manufacturing costs. Again, you can't look at those without considering how good a shoe am I building vis-a-vis my competitors. Down here in these benchmarks, again, you have to put things in context. You see wide differences in the marketing expenses, particularly in internet. A lot of this has to do with volume, pure and simple. Now, these sorts of things, this is where you do want them to all be high. Operating profits. Again, you can see that historically the operating profits are much larger in the internet because you cut out the middlemen. You can see in the wholesale markets, not a lot of money. So in terms of the averages, the best region was North America at 780. Now you can see why that 70 cents per shoe in manufacturing is a pretty big deal, because that's 10% of somebody could have boosted their margin by 10% of the actual profits just by having lower cost. You come down here in Latin America where the margins are pretty thin, and that 70 cents in your labor cost really looms large. Private label market, this is excellent profitability in the private label market. I'm sorry, that's the cost of pair sold. So now we get down into the margins. You can see the margins are pretty highly variable. In fact, somebody sold them at a loss in North America. Last page, this is who won the celebrities. Team F stepped out and signed all three of them, $5 million each. You all will be able to figure out whether that was a good price or a bad price. And in practice round 2, they're going to have a lot of celebrity appeal that's going to help them out. They're also going to have $15 million a year in marketing expense that they're paying to their celebrities, I should say. And then this is really good for seeing the big picture trends. So we saw the trend was in North America, internet price down, SQ rating up, price up. And that trend held in several of the regions, although here the SQ rating went down, price was static, price increased ever so slightly, and SQ rating came down. That's the Footwear Industry Report. It's the first of your 3 major products to look through, and I'm going to end this video and come back and join me while we look at the Competitive Intelligence Report.